and welcome to Forex Webinar 6, Charts and Patterns. For those of you who haven't seen my earlier webinars, a little introduction. My name is Jelle Peters. I'm the writer of Forex for Ambitious Beginners, which is among other stores available in the Amazon store, both as a paperback and for the Kindle. I'm a writer for financial media, and I frequently give webinars like these and seminars for the other companies. Okay, so in this webinar, we're going to look at how to read candlestick charts, what candlestick patterns are, and how to recognize them, what is support and resistance exactly, and how can you benefit from it, and some chart patterns that you could also use to trade profitably. Okay, so there are three different kind of charts basically. You have line charts, bar charts, and candlestick charts. Now this is an example of a line chart. It's very simple. It's just writing down different closing prices, and based on that you get a line showing you the development of closing prices. It does give you, of course, information about the development of prices, which is very basic. Now the bar chart already gives you a little more information, because now you can also see whether or not the closing price was lower than before. So you can see that easier. You can see how high the price climbed and how low it fell. So this gives you a little bit more information. Now the candlestick chart gives you decidedly more information than that, which is probably why it's the most popular one, because it's still very easy to read. And the candlestick chart, besides showing you quickly that a red candle is obviously falling and a green candle is a rising candle, it shows you how far the prices reached. It shows you the closing price, how close that was to the low or the high of the period, and it shows you. Therefore, it shows you easier periods of indecisive and periods of very decisive movements. Now, to give you a little information, I took a picture here to show you the different parts of the candle. Now, if you look at this, if the candle is red, then the closing price is the lower part of the body. The body is just called this little red part. The thick part is the body, and here is the green part, of course. So if it's a red candle, then the closing price is the lower part of the body. If it's a green candle, then the higher part of the body is the closing price. So it's the other way around. The shadows obviously point to how far the prices reached. So immediately, one of the interesting things that you can do is, for instance, if you look at let's look at this candle. This red candle here, it has a very small shadow on the bottom and higher on the top. Now the candle is red, which means that the closing price is the the lower end of the body here. So it was very close to the lowest point in that period that the candle closed, which is a lot different from, for instance, this candle here, which is still a red candle, but apparently, even though the price fell to this point, there is a very long shadow, meaning that all this territory was given back again to the bulls, to rising prices, because the closing price, even though it was lower than the last candle, is considerably above the lower point of the shadow. So that immediately gives you a lot of information. Now, because of this, there are many candlestick patterns. Really, there are many books written about it. So if you're interested in this, I would advise you to look them up. Many good books written about it. I just want to show you a little bit here. How they do give you some information. For instance, if you look at this engulfing pattern, it makes sense. It's also common sense to see. Okay, we have a small negative candle, small red candle, which is followed by a big green candle, big rising candle. That is a bullish signal. It means that apparently the momentum has changed. Now there are several candles like this. I can't go into them all. I can tell you that obviously this is another signal where you can see, okay, we had a big negative candle, and then suddenly we have a small but optimistic green candle. is also a bullish pattern. The Doge, which I want to show you here, the Doji, is an example of indecisiveness. It's really neither bullish nor bearish, or you could use them as both, because if there is a bearish period and it's followed by this candle, then there is a chance that there is a trend reversal. But the same goes for bearish patterns. Actually, I think I have that here as well. Yeah, here you have bearish patterns, which are the opposite of the bullish candlestick patterns. But the doji here is the same, because it's a sign of indecisiveness. Why? Well, the closing price was the same in this period as the period before, so nothing really changed. There was a little movement up and down, but there was no clear direction. Now, if before there was a clear direction, then now it's a sign that things might start to change. Now, bear with me here that this does not mean that whenever you see this candle, that now obviously the prices, the trending direction is going to change. It doesn't work that way. Candlestick patterns show you signals, can help you, confirm other signals that you see in technical indicators, that you get from fundamentals. And it's just another sign that your setup is going to work, or that you should wait with the trade. Now, just a simple pop quiz. What do you think? This is a bullish or a bearish pattern? It's a very famous pattern in candlestick charts. Take a moment to think about it. Obviously, this is a bullish pattern. Why? Well, there are three strong green candles here after a downward sloping movement. So here you have a very strong signal that things are looking up again for whatever financial instrument is trading here. It's a pattern which is called the three white soldiers. This is a bullish pattern. You also have three black soldiers. That is a bearish signal. Then, of course, those three big candles are the other way around. Okay, so chart patterns. Now, price movements aren't completely random, and that is because prices themselves, price development itself, isn't completely random, because humans and software actions, of course, are, at least in the longer term, rational. They are based on underlying fundamentals. For instance, if consumer sentiment is improving and people start buying more stuff, then you can imagine that the order intake of factories is increasing, and that means that if you were looking at a currency, for instance, a currency pair dollar versus a British pound, and the American economy is doing much better than the British economy, you can imagine that the dollar will move up against the British pound. So people are going to act on that. This is why price movements aren't completely random. Now, what plays an important part in prices in charts is support and resistance. You see, chart patterns are caused by support and resistance levels, and by past price movements, among other things. Support is a level where a falling price often finds support where it can break through, and resistance is the other way around. Means it's a ceiling where prices have difficulty breaking through. These can be psychological barriers. They can be barriers that are based on something real, because it has been known to be a barrier before, but they have that effect. Now here I have a chart which can help explain a couple of things, how you can benefit from this. In this candlestick chart, you can see that we have a support level, clear support level here, which means that if let's say the first time the support level is, let's pretend for a moment that it's actually being established here, the support level. So the first time it can get through, and then the second time it can get through, and then the third time it also can get through. Now at this point you can start thinking, okay, this is a good moment to take a position, to take a long position, because apparently the price can move beyond the support level. And if you do, you can get a nice uptrend. Now here there is a resistance level established, so you hold on to your position, but maybe after a couple of times you say, okay, I'm going to leave my position now, I'm going to take my profit, I'm going to stay out, and I'm going to take a short position the next time it hits that ceiling, which is here. And then you can benefit from a short position. Now, I'm not saying that, you know, that you can always do it like that, but what it does show you is that you could generate buy signals and sell signals, entries and exits, based on support and resistance levels. Now, there are also, of course, chart patterns based on this. For instance, this is the head and shoulder pattern. What happens here is that you have the neckline here is a slightly falling trend line, right? So you have the bulls here which make a new high, which is positive. They can't keep it up though, so the prices recede, they fall back to the neckline, and then the bulls start again. They build up new momentum and they make a new high. Now this in itself is at this point you think, okay, this is a positive sign. This means that prices might go up. The problem is here that the prices fall down again, and the significant part of this particular pattern is the shoulder, the second shoulder. The second shoulder is a very weak sign for the bulls, because here it seems they cannot. They try again. They try to move to bring the price up again, but they can't move beyond the point of the first shoulder. They don't get to the head level anymore. So now you see that there's a strong signal here that the bulls might be running out of steam, and you can take a position if the neckline is broken. So then you have two signals. You have one signal that there is not a higher high. In fact, there is a lower high that is made, and the second signal would be when the neckline is broken, and then you can take a position here, and you can make this as a profit. It's a very strong signal. Now this is a double bottom. Obviously you have them in double top as well. What happens here is the price makes a low, makes a new low that is significant. It doesn't break beyond the neckline. Then the bears try again, but this time they can't reach that point that they reached before, so they make a higher low. They go to the neckline again, and then they break it. This is also a buy signal. This is a signal that you could take in a position, because apparently the bears have run out of steam. Obviously, a double top would do the opposite. It's also an interesting pattern. It's a symmetrical triangle. What happens here is there is indecisiveness in the market. So you see that the lows become higher and the highs become lower, meaning that prices come together more and more. At this point, it's not very visible. It's not clear whether or not the break is going to be up top, to the top, or to the bottom. So you could take a stop order for both, you know, a long beyond that triggers a long from a certain price point on, or it triggers a short from a certain price point on. But in any case, the chances of a breakout are very high here. And in this case, the breakout was to the top end. This is an ascending triangle. You also have a descending triangle, of course. The descending triangle means that the lows become higher. So this higher lows. You have a low here, but then this low is higher. This low is even higher, whereas the resistance stays the same. Now, this is a signal that the chances of a breakout to the top, to the high end, is higher than the chance of breakout to the bottom. This is not the same as a symmetrical triangle, because here the resistance stays the same, but the support gets higher and higher. So there are several of these chart patterns. And the conclusion is that recognizing a chart pattern can be the start of very profitable trades. I hope I've shown you that. You don't need technical indicators to recognize these patterns, just a lot of practice, because obviously I've shown you here the most you know, very clear ones, but it takes practice to recognize them. Okay, next webinar is the last in the series. We're going to look at the 6 simple secrets of successful Forex traders. It's going to be very interesting, so I hope you're going to watch it. For now, thank you very much for watching, and see you at the next and last webinar.